Hello, Hunter. Excuse me, went down the wrong pipe. Hi, Leanna.
Hi.
Hello.
Anybody want to show their face?
No, thank you.
That's what the students tell me I should do. Hunter, you want to show your mug, or you don't want me to catch you on the street one day, huh? Hunter's thinking about it. Yeah, you were here. You were here Monday, right? I'm sorry, Tuesday, right, Liana?
Yeah, I was.
Was that helpful, that session at all?
Yeah, it was. I hadn't gotten my book yet, so it was kind of just like telling me a little bit what was going on.
Yeah.
But now that I have my book and everything, and I did see the slideshow, because I didn't know that the slideshow was also available for us to see. I thought you were going a little too fast.
Hello?
But now that I know that it's on there, I was
Right.
able to see it.
Yeah. When you say
Hello.
the slide, oh, hi, Rodrigo. How you doing? Could you unmute Rodrigo?
Hello?
Is that you, Rodrigo? We need.
It was. I'm here. Good morning.
Hi, Rodrigo. How you doing?
Good morning.
Hey, Rodrigo, you want to show your face so I can see at least one of my students? Thank
I'm
you.
here.
That's right. You were here the
Sure.
other day, right?
Yeah, I was here at first. I'll be here every day.
All right. Well, we'll have some great fun then. Here comes Antonio. We'll give another minute or so. What we're going to do is we'll go into chapter 2. Okay. Chapter 1 was just a little bit of an introduction to some basic terms about accounting. That'll be worth a couple of multiple choice questions on the test. But what we'll do today is we'll go into chapter 2 and introduce a few basic things and go through some transactions. And then chapter 3, that's when we'll really get going into the world of accounting. Hi, Antonio.
Hello.
Do you want to show your face, Antonio? All right. At least I have two people I can look at. Okay, it's 10:02. And I know I'm going to have to trim the first 5 minutes of this discussion. My boss doesn't like it when I'm goofing around like this. But let's see what we got here, okay? We are going to go into chapter 2. And I can always go back to chapter 1 if anybody feels that would be appropriate, okay? So let's make sure I have the right slide in front of me here. And I do believe this is it. Now give me a second to share screen, and boom. Can you see the PowerPoint now?
Yeah.
Okay. All right. Anybody ever watch The Big Bang Theory on television? Anybody know that show? No? If you know Sheldon Cooper, that's me. I have to set this up the way I like. Okay, there we go. All right. The accounting transactions, okay? Analyzing transactions. Let's see what we have here. Look at this simple slide. Define the accounting elements, huh? A business is an entity whose financial position can be measured at any time for any period of time, okay? And with small businesses, you have to be careful to separate what's a personal expense from the owner, from the normal business, okay? So let's see what we're going to learn here. The owner of a business may have business assets and also non-business assets that need to be separated and maybe monitored. Non-business assets, not part of the business. If the owner invests money or assets in the business, that's now a business asset. And what they're simply getting at here, and you'll see shortly, is a small business, perhaps a small store, a flower shop. A sole proprietor starts the business with an investment of, say, $10,000, and the business is going good. And then the owner, he or she, decides to take some money out of the business for their own use. And they go out to the accounting guy who's ever in charge of writing a check. And they say, Rodrigo, would you please cut me a check for $500? And you'll say, yes, boss, what for? and you say, I'm taking my wife to Las Vegas for the weekend. Well, you know that's a personal expense. And we're going to learn that's called a drawing and handle that appropriately. We're going to start you off with an equation. Assets equal liabilities plus equity. But before we get there, let's understand what we're talking about. Assets. An asset is anything that we own of value. Anything we own of value that helps us make a profit. Assets. They must be owned. You can't rent an asset, and you don't have to pay them off. In other words, you buy a gigantic machine for $100,000, and the deal is you pay it off over 20 years. Well, you own that machine, okay, as opposed to leasing it. Assets, something good to have. Cash is a wonderful asset to have. It's our favorite. Merchandise, inventory, furniture, fixtures, machine, etc. Building, land, and accounts receivable, which they put on the bottom. It really should be second. Accounts receivable, that's the amount of money your customers owe you at that exact point in time. You have a number on your general ledger, and that number is $1 million, and you can see that Antonio owes us some of it, Leanna, etc. Accounts receivable, the amount of money owed to the business by its customers as a result of making sales on account or on credit. And then they're saying, simply put, the customers promise to pay in the future. You see that expression, on account? I like to tell the students, get in the habit of finishing it by saying, on account of nobody had money. Because this is a sale where the cash is going to be turned in later. Okay, accounts receivable, that's a sale for credit as opposed for cash. So if an asset is something good to own, we have something called liabilities. A liability is a debt. It's the money we owe to people, to banks. A liability is a payable. You're going to be seeing accounts payable all over the place. Notes payable, perhaps bonds payable, salaries payable. These are your payables. This is money that you owe, and you're going to be probably paying them with cash, huh? Notes payable, accounts payable. Accounts receivable, money owed to us at that particular time by our customers. The reciprocal to the customer, it's their accounts payable. One man's accounts receivable is another accounts payable. Accounts payable. Notice it says unwritten. That's kind of a meaningful word. I'll explain it in a second. An unwritten promise to pay a supplier for assets purchased or services rendered. The reason we put the word unwritten there, it is not a contractual obligation. When you sell somebody on credit, you are giving them the opportunity to pay later, and you trust that they will pay you. There's not a formal note. If there was a note involved, in other words, if you sign a contract that you must pay me at this time, that would be a written promise, but it also would not be what's known as accounts payable. You decide who you purchase from or sell to, and you make a determination as to how much credit you want to give them or extend. Purchase on account and nobody had money. And be careful, don't confuse accounts receivable and accounts payable. Ask yourself, are we getting the money in this transaction, or are we paying the money? And I don't think anybody's ever made that mistake before. You will all make that mistake at one time or another as we get started, huh? Notes payable, notes payable. Notes payable, this is the formal note. If the accounts payable, if you don't pay, if your vendors don't pay you on an accounts payable basis, well, you can do what you can to collect it. You can sue them and, pursue all those things, but you can't present a written contract. Notes payable, you borrowed money from a bank, basically. Notes payable, you borrowed $100,000 from me, and you promised to pay me $100,000 back in 5 years, but I'm charging you 20% interest. So you have to pay me $20,000 a year in interest. That's a formal contract. And if there was a clash between notes payable and accounts payable, Notes payable, people get paid first. The third part of our calculation, owner's equity. This is by how much assets exceed the liabilities. There's a whole bunch of names for this: net worth, capital, equity, stockholders' equity, shareholders' equity. It's what's called the net worth of the business. And we're going to introduce you to my accounting equation here. Let's look at this slide. I don't think is too meaningful. Let's take a look. And next time you buy something, think of all the assets a company needs to produce, huh? Investments in asset. They must price the product high enough to cover the cost of using the assets and replacing them when they wear out. For example, AT&T recently reported the cost of property, plant, and equipment for operating was $319 billion. AT&T spends $319 billion, and my cell phone still won't work on campus. That's what I take away from that. The accounting equation, and this needs to be tattooed where you can see it all the time. Assets equal liabilities plus equity. Assets equal liabilities plus equity. Assets, it's on the left side there, huh? Assets. I have a business and my assets are solid. I have $1 million worth of cash and accounts receivable. $1 million, and that's a good number. If I offered to sell my business to you for $100,000 based on that, would you do it? Maybe not. It's possible I have liabilities of $2 million. In other words, you have assets, that's great, but you must subtract the amount of money you owe to people, all your payables. That number, assets minus liabilities, equals owner's equity, or what the business is worth on paper. Assets equals liabilities plus equity, and that equation must always remain in balance. It can never, ever go out of balance. Now, today we're in the 21st century where everything's done with a really strong PC package, perhaps, or something like QuickBooks. No computer system will ever allow you to post an out of balance entry, I don't think. But we have to understand the equation. Assets equals liabilities plus equity. When I used to have to do this stuff in pencil 100 years ago, you could go out of balance because you made a mistake. Okay, a business has total assets of $60,400. Total liabilities, they owe their vendors $5,400. What is the equity? Well, once the debts are paid, the remaining asset belong to the owner. So, extrapolated from the equation, liabilities 64,000. I'm sorry, assets 60,400 minus the liabilities. There's your equity. And the accounting equation must always remain in balance at all times. Assets must equal liabilities plus equity. So what we're going to do here is we're going to look at some transactions. And in chapter 2, it's just to get you comfortable with keeping the equation balanced. And we're going to use words like increase, decrease, plus, minus, up, down, more or less. And when we get to chapter 3, we're going to repeat many of these transactions using the accounting terminology and the accounting tools, as opposed to this horizontal look you're going to get right here. A business transaction, it's an economic event that has an impact on the business. It can be something as simple, you open the mail and there's the electric bill. That's an economic transaction. Uh-oh, the electric bill's here, it's $300, that looks about right. And you enter it into your accounting system, transaction. It could be as complicated as negotiating a big lease and making a down payment. And the economic event usually involves an outside party, okay? We collect money from customers, we service customers, we pay people, we pay our employees. most business transactions involve an independent second company we deal with. Chapter 4, you'll learn about something internal called adjusting journal entries. And who knew this one, huh? Must be able to measure it in dollars. All business transactions affect the accounting equation through different accounts, okay? Different accounts. Forgive me for skipping along so fast. I got happy fingers today for some reason. An account. Cash is an account. Accounts receivable is an account. Accounts payable is an account. Equity. Then when we get into our sales and revenues, sales is an account. Electric expense. A separate record used to summarize changes in each asset, liability, and owner's equity of a business. Think of them as folders where you're putting in the transactions. Here, we'll talk about this a little bit. We're going to look at some transactions in a moment, huh? And they're suggesting 3 questions. What happened? Make sure you understand what has taken place. Again, I go back to my simple example of the famous electric bill. Well, what happened? Well, you got the electric bill. We know that that is an expense of the company, and we know we now have to record that. So the question becomes, what accounts are affected? What accounts are affected? Is it an asset, a liability? Once we know that, then we can determine which accounts go up and down, keeping the equation in balance. Show the effects of business transactions on the accounting equation, all right? I love how they have these tiny little sentences on these slides. That's the whole thing. Let's analyze the effect of the transactions on the accounting equation. Our first transaction of the class, Mitchell Williams, the owner, invested $5,000 in the business, in his business. What happened? He took $5,000 from his personal bank account, and then he opened up a business account with Bank of America or Santa Barbara Bank and Trust, and he put it into his business account. So what 2 accounts are affected? Cash. This business now has cash, so cash is going to go up. And now he has a business that's worth $5,000, right? So the capital is going to go up 5,000. So let's take a look at this. Investment by the owner. Well, they're telling you cash is involved and equity, okay? Cash and equity. Cash increased, so does equity. So let's see if they give us a grid to look at. Here we go. There's your accounting equation starting off. So far, we just have one asset, $5,000 put into this business. And now the business is worth $5,000. Notice they're calling it owner's equity, and then underneath they got owner's investment. Like I said, a lot of names for that. Okay, that's not so tough, I don't think, to get us started. Now he bought an asset. He bought an asset for cash. That's what happened. Well, it looks like he had to pay for it with cash. So cash is an asset that went down. Delivering equipment is an asset that went up. It's just a switch of, just a flip of assets. We spent $2,000 to buy some delivery equipment. Cash decreased and the equipment increased. And they're using this expression here, traded one asset for another. Well, that's what you do every day in the business world. One asset increased, the other decreased. So now this has been expanded ever so slightly. We had $5,000 to begin with in cash, and now we spent $2,000 to bring in a different asset. So our assets remain $5,000, and the total equity is still $5,000. Here we go. Now we have to think a little more here. Purchase of an asset on account. on account of nobody had money. So you know, as soon as you see the words on account, there is no cash involved in the transaction, okay? So he bought delivery equipment for $1,800. He bought more delivery equipment. And the seller says, you got to pay me over the next 3 months. So let's think about this, huh? No cash. Well, we got a piece of delivery equipment. So the assets go up, and we're going to call that particular asset delivery equipment. And now we owe the provider. That's called accounts payable. We now have taken on a debt of $1,800. We are going to pay in the future. Our assets went up by 18, but so did our liabilities. Now you notice the equation. If anybody can't read those numbers, let me know. Sometimes people tell me stuff is too small. So what happened here? Well, we didn't touch cash this time. We did get an $1,800 piece of equipment. So now our assets have gone from $5,000 to $6,800, but we owe $1,800. $6,800 minus $1,800 tells us the accounting equation is in balance. Okay, accounts payable. And one of the transactions we might get in a few moments might be when we pay that bill, okay? Payment on a loan, okay? Now, what they didn't tell us, now this is a little bit of a mistake, but I'm not going to worry about it. We'll call it accounts payable. It's really a note. Okay, he paid back some of the loan. He owed $1,800. So what happened? You decided you could pay 1/3 a month. Well, when you pay the $600, your cash is going to go down, right? We spent money. Cash is going to go down. And what's going to happen to accounts payable? That's going down as well. We owed this guy $1,800. Now we're paying down $600 of it. So we're going to increase that. We're going to look at cash and accounts payable. Cash decreased, so did accounts payable. We don't owe that $600 anymore. So let's take another peek. Well, we had $3,000 in cash before this transaction. We spent $600, so we're down to $2,400. So our assets went down. They were $6,800 earlier, if you remember. But look at our payables. We don't owe $1,800 anymore. We owe $1,200. $1,200 plus $5,000 equity. We are in balance. Now we're going to talk about two other things, revenues and expenses, okay? Revenue means a sale of your product, basically. You performed a service and you expect to get paid for it, or you got paid for it immediately. Revenue is the amount a company charges customers for products sold or services performed, okay? Revenues, think of it as sales. Now, here's the first important accounting principle that we need to understand. You record a revenue, a sale, when you make the sale, not when the cash is paid. And that's an important thing, and you'll get used to this after a while. It's recognized when you earn the sale. For example, you have a service company and you did some consulting for me, and you did it during the month of August. And you did $1,000 worth of consulting for me. You, in the month of August, are going to record that revenue in August financial statements, even though I may not pay you for another 2 months. So get in the habit that the cash does not necessarily follow the sale or the related expenses, okay? Revenue will increase your assets. It's going to be either cash or accounts receivable and owner's equity. And they're talking about different kinds of revenue here. At this point in the course, we're just working with a simple service company. Mitch Williams, he cuts lawns, I think, basically, huh? And they're just showing you different accounts, different folders you may want to have in your general ledger. Delivery fees, consulting, rent revenue. I worked for many years for a company in downtown Los Angeles, a beat up old factory in Little Tokyo, if you know that area of Los Angeles. We had an old factory and we rented out probably 1/4 of it to tenants. So that was another stream of income, revenue, interest revenue. Maybe you loan people money and they pay you back with interest. Well, it's nice when you sell a product, but you can't sell a product or run a business without incurring expenses. And I think we should know that sales minus expenses is going to be called your profit. And I think we understand that. You don't need to come to school for that. But you sell something, you have revenue. You must also be sure to record the appropriate expenses. And they're calling an expense a decrease in assets or increase in liabilities. I would ignore that particular sentence. That confuses even me. That's not a good way to look at it, okay? Just like you have separate asset accounts, cash, receivables, inventory, equipment, you have different expense accounts. Who knew? Rent, salaries, supplies, taxes, maybe fringe benefits, health insurance, insurance itself, all kinds of expenses. You could have thousands of them if you want to be very specific. Expenses. This is something that will be on the test probably in the form of a multiple choice or true false. The accounting period concept. Believe it or not, in the world of accounting, there's a term called periodicity. I think it's pronounced periodicity. And all it means is this. You can look at a company for 1 month and isolate that 1 month and see how they did for that month. You could do it for a quarter. You could do it for a year. It's the concept that a business is an ongoing concern, which you can then divide into specific reporting periods, typically monthly. Any place I've ever seen, they, quote, close the books monthly. Counting period concept. Okay, net income, net loss. On the lower left, in blue, this company had revenue of $9,000 and their expenses were $5,000. So they made a very nice profit, huh? They made like 44% on their money. Net loss, revenues were $3,000, but the expenses were $5,000. They lost money. Not good. Revenues minus expenses equal your income, okay? Now, here's what I was talking about a little bit earlier, about keeping the personal affairs of, I don't mean an affair a boss might be having with a secretary. Okay, I'm being silly. I'm talking about the business affairs of the owner. The owner takes cash out of the business. That is going to reduce the assets, but it's not an expense. It's not a business expense. It reduces the equity. It reduces the equity through an account that we call drawing or withdrawals, okay? Again, let me know if you can't read the numbers. So notice what's happened here. They have now expanded our equation, assets equals liability plus equity. And in the equity section, we now have 2 categories. 5,000 is the capital. And now they've put up the drawing. And notice next to it, we see revenues and expenses. And we'll get to that very quickly. Note that revenues increase owner's equity, expenses decrease it. Okay? Revenues increase equity, expenses decrease it. And why didn't they give us a problem in that? Okay, we'll get there. Okay, now we're going to look at a transaction that affects the income statement, if you will. Here, we're going to have a transaction where we did some work. We delivered some pizzas or whatever this guy does, and we got cash for it. So, excuse me. Mitch received $2,100 for some deliveries he made. Okay, that's what happened. Well, he received cash, so cash is going to go up. But you know what else went up? Delivery fees, which is what he calls his revenues. Delivery fees went up. Cash increased by 2,100 and revenues increased by 2,100. No liabilities here, it was just a cash deal. Take a look now at your colored areas. If you look to the right, you are seeing your first revenue transaction. Revenues went up and assets went up. So we had 6,200, I guess, before, right? Famous 6,200. Now that has been increased by this $2,100 cash sale. We're still in balance, 8,300, 8,300. Uh-oh, got to pay the rent in June. Oh, got to pay the rent. Well, we're going to pay it with cash. Who knew? Pay the rent, cash goes down, and rent expense goes up. So now the equity of the company is going to go down by this amount. We paid the rent. So we're going to have an expense in our general ledger, a folder, an account called rent expense. And here we go in that red color. We have an expense there. And that says $1,000. The expense is getting bigger. If the business, if the month ended today and this was all the activity, this company would have a profit of $1,100. Their sales were $2,100 and their only expense was the rent, $1,000. So they have a profit of $1,100. And what you're going to learn in a chapter 2 is how that gets rolled over to the capital at month end. Here's another expense. We paid the phone bill, $100. We paid. As soon as you see the word paid, you know it's going to be a decrease in cash. Cash goes down. Whoa, that's an expense. There we go. Now we lost $100 of our profit. We're down to $1,000, okay? Cash goes down, expenses go up. Now, Mitch performed delivery services for $2,400. No cash at this time. Accounts receivable is the asset that's going to go up, not cash. Delivery revenues earned on account of nobody had money. Mitch delivered the pizzas or whatever he does. So he now records that revenue at that date. The date that he brought the pizzas into the party, he has earned the revenue. It does, the cash that is irrelevant. So let's think about it. Well, he didn't get any cash, but these people owe us $2,400. And the amount that your customers owe you at any point in time is called accounts receivable, okay? To us, it's accounts receivable. To City College, where he delivered the pizza to my office the other day, that's a payable, okay? So what accounts are affected? Accounts receivable, that asset goes up, and so do delivery fees. Hey, now that's looking pretty good, huh? $2,400 in revenue. Our revenues have grown to $4,500. And we have a new asset we're introducing, accounts receivable. Accounts receivable, that's our second favorite asset. Accounts receivable is what we call a current asset. And typically the terms are 30 days. It could be anything the two companies agree on, but typically it's 30 days. You want to buy something from me, you got to pay me in 30 days. Purchase supplies. Okay, let me take a breath here. He purchased supplies. These supplies should last for several months. Until the supplies are actually used, this is not an expense. Supplies, we're going to call an asset. It's an asset. And you're going to learn in chapter 4, I think it is, that we will adjust this asset based on how much we use in the future. So for now, he bought another asset, supplies. That asset went up, cash went down, okay? Take a look, please. $80, cash went down. This asset of $80 increased as well. This is called a prepaid expense account, since the supplies will be charged off as they're used. And let's not worry about that at this point. Jay, hey, now we're getting paid. We're getting paid. Remember, we had a couple of deliveries. We had some, it was like $4,500, right? If I remember correctly, in sales. Well, now one of our customers is finally going to pay us. They're paying us for services performed earlier in the month. When we get this payment, there is no impact at all on the equity. In fact, the counting equation is not going to change at all. Everything is going to stay the same, except the components of the assets. When we receive the money, our cash increased. What decreased? What decreased was accounts receivable. This customer no longer owes us that money, okay? So let's see what we have here. We just got paid $1,900, okay? Customers owed us a total of $2,400. One of them just paid $1,900. So our cash went up, the receivables went down. It's just called a switch in asset, changing, flipping assets. The important thing to remember with those big capital letters earned, revenue is recognized when it's earned, not necessarily when the cash is received, okay? Oh my goodness, now they're complicating things. Purchase of an asset on account and nobody had money, except somebody did have a little bit of a down payment, if you will, okay? So Mitchell went out and he bought a scooter for $1,000. So he just purchased an asset for $1,000, huh? But he paid $300 in cash now, which means he has to pay the balance of $700 later on sometime, and that is called accounts payable. To the motor scooter company, that's their receivable. To us, Mitchell, it's our payable. Okay, so we understand what happened. What accounts are affected? Well, we know he calls his equipment delivery equipment, so that's going to go up probably by that $1,000, not probably, by $1,000. Cash is going to decrease by $300, and he owes the $700 difference. So cash goes down by $300, delivery equipment increased, and the difference is a payable for later on. So let's take a peek at what we have here. Here's the transaction K. He bought a piece of equipment for $1,000. He paid $300, and he now owes $1,900. Okay. And what you're going to learn is that every single transaction in the business world, you must have minimum 2 accounts. You can't just have 1 account in a transaction. Here you're seeing you can have more than 2. You can have 100, depending on what the situation might be. Now he's paying for insurance. This is another prepaid expense, okay? It's prepaid. Mitch paid $700 for an insurance policy that lasts 7 months, okay? And that's an important piece of information because when he purchased this insurance policy, it's an asset. It's something of value that will help the business later. He now has insurance coverage for the next 7 months, okay? Since the policy provides future benefits, it's an asset. So we had prepaid supplies before. Now we have prepaid insurance. Cash went down by 700 and we have an asset, prepaid insurance. And here we go. They've added a new asset called prepaid insurance. And we had to pay cash for it. And our accounting equation's been growing. We started off with 5,000 and we're up to 10,300, huh? Guess what? Businesses have employees. You know, Mitch isn't the only one delivering these pizzas. He's got some people working for him. Now it's time to pay them, huh? It's payday. Well, he's going to pay them in cash, huh? Cash is going to go down. And guess what? Those people delivering those pizzas for him, those are people earning a salary or a wage. So we're going to debit an account called wages expense. You could call it salaries and wages, if you will. They have the same meaning. Salary, when you say salary expense, you're typically talking about a non-exempt office type employee, as opposed to a wage where you're getting paid per hour. That's all. So, well, we know our equity's going to go down. So what happened here? We paid $1,650, and that is an expense, $1,650. So our equity is going to go down. And here we go. You see the cash being reduced. Our equity is down, our assets are down to 8650, and now our equity is down. Our equity is down because we have an additional expense. As with other expenses, cash is reduced and equity is reduced by increasing an expense. Now he's made a sale for cash, and on account of nobody had enough money to pay the balance, huh? So now he made a fresh delivery. He delivered $3,500 worth of pizza pies to a college campus, okay? And he received $900 with the hope of getting paid the balance of $2,600 in 30 days. So what accounts are involved? Deliveries, that's revenue. He calls them delivery fees, right? Cash, he got $900 in his pocket now in cash. And he's got another asset that increased, and that's accounts receivable. Revenue is going to increase the owner's equity. Cash increased by 9. Accounts receivable increased by 2,600. And the fees went up by 3,500. And there we go. There we go. Here is our 3-part transaction. Revenue went up 3,500, and we received a payment of cash for 900, and an understanding that they'll pay the 2,600 in, I'm going to say, 30 days. Recording these revenues impacts 3 accounts while the equation remains in balance. Getting toward the end here. Here's the withdrawal. I wish they had changed the sequence a little bit, but that's okay. Mitch took $3,000 out of the business for personal expenses. And this is typical of a small business, a small mom and pop shop, perhaps. You don't even pay yourself a salary. You just take money out of the business when you feel like it. That's fine, nothing wrong with that. It's your business. But it's our business too in the accounting world. So he took $3,000 out, And before you wrote him that check, you said, hey, Mitch, what's this money for, please? So I know where to put it. And he says, I'm going on vacation for a week. You know, it is not a company expense. Cash went down, and so did owner's equity. When the owner takes money, assets away from his business for his personal use, the equity of the company goes down. The company is now worth $3,000 less than it was before you cut this check. So what's happening here? Cash is going to decrease, and this drawing account is going to go up, which reduces the equity. So let's take a look at this. You wrote him a check for $3,000, and we know it reduces capital. But you never put the drawing, you never code the drawing to the account called capital. We're going to code it to the account called drawing, so that the equity is, the equity is now $2,000 at this point, if you look at it this way. The drawing is the account we use to reduce the equity. Withdrawals by the owner are reported in the drawing. I'm so sorry, guys. Withdrawals by the owner are reported in the drawing account. Withdrawals are the opposite of investments by the owner. Just like expenses, the drawing account will increase, but it knocks down the owner's equity. Prepare and describe the purposes of a simple income statement, statement of owner's equity, and balance sheet. Good gosh, what do they have for us here? Okay. These are your three basic financial statements that everybody looks at. An investor is looking at possibly buying shares of a company. They'll probably want to see these financial statements. They want to see the income statement to see if they're making money. They want to see if at least their sales exceed their expenses. He might want to look at the statement of owner's equity, which shows you the beginning equity and then the elements that led to the ending equity number. Your equity at the beginning of the year was 10,000. Now it's 14. That statement will tell you why it went up. And the balance sheet is a snapshot of the accounting equation. The snapshot is the snapshot. The balance sheet is a photograph of the accounting equation at month end. It says at this point in time, December 31st, we have $100 in cash, $50 in receivable, etc. Financial statements, income statement, owner's equity, balance sheet, and they must be prepared in that order. You can't do the balance sheet first and then do the income statement. Cannot be done. It's impossible. You have headings on the statements. Typically, when you issue financial statements to the world, it says the Rodrigo Company, income statement, and then it'll say for the period of, or the month of. So Mitchell's campus delivery, this is the income statement for, in this case, the month of June 2025. Okay. Some guidelines on preparing the financial statements. Let me point out a couple things. The financial statements are provided primarily for users not associated with the company. Okay. You must have blessed financial statements attested to by a CPA before your business can really do anything. Without verified financial statements, you can't borrow money. You can't get any credit at all. Nobody is going to sell anything to you except for cash. So these financial statements are important to possible investors, to vendors, suppliers. It's also important to management, obviously. Management needs to know if we're making money. In fact, it's important to you as an employee. You, for example, might have a bonus deal going with the company that says you get a $100 bonus if the company meets certain targets. So you certainly want to see those financial statements. And they're talking about things like double lines and all that kind of thing. I'm not going to worry about the lines, okay? Here it says some companies list assets from highest to lowest. No way. I have never seen that. You would never do that. But I guess some companies do. The reason you wouldn't do it is because the order isn't the same each month and you can never compare them easily. On the balance sheet, assets are listed from most liquid to least liquid. Liquidity is a word that means the ease with which an asset can be turned into cash, okay? Current liquidity is the ease of turning an asset into cash. So you're always going to start your chart of accounts, your balance sheet, with cash, typically receivables, the supplies and insurance, inventory. Those are the items that you're going to turn into cash most frequently. Building and equipment, well, that's a long-term asset. You're going to keep that for a long time. And liabilities are also listed in order of liquidity. You can have long-term assets. Give me 1 second here. Okay, let's get our first look at an income statement. An income statement, it's the first one we need to do. It reports the profitability of the company for a specific period of time. That was that period concept we talked about before. It reports the profitability. Expenses subtracted from revenues to see if we made money, called net income. You can also call this the profit and loss statement or operating statement, but income statement. Let's stick with that. That's good whiskey. Mitchell's Campus Delivery. Notice the heading that we just talked about. Mitchell's Campus Delivery income statement for the month ended or the month of. Revenues. Revenues were $8,000. So we put that on the far right here. And the expenses are separated in a separate little column to make it look nice. And we had 3 expenses: wages, rent, phone. Remember those 3 transactions? So his total expenses were $2,750. He made a profit of $5,250. He earned a profit close to 65%. That's a pretty good rate of return, huh? In 1 month. Let me know if you know any banks that pay that kind of interest. We'll roll them down there. And they're just suggesting these underlines. We're not going to worry about that. Okay. Remember I said the income statement is the first of the 3 statements that are done at month end? Here is the reason why. Once we have the income statement, we can now update the second statement, which is the statement of owner's equity. And this reports the activities that affected the owner's equity. So we're going to go back to our income statement, which is $5,250. And we're going to add it to the beginning equity. So you recall he began this business with a $5,000 investment. Remember, Mitchell put $5,000 of his own money in the company bank. So the business at that time was worth $5,000. What was his profit? $5,250. So we will add that to the 5,000. But what else did he do? He withdrew $3,000. Remember, he came out and said he was going on vacation. So the difference between those numbers is $2,250. So his equity grew from $5,000 to $7,250. So he had a pretty productive month, a pretty profitable month, I would say, huh? Now that we have the statement of equity, we're going to take that 7250 number and stuff it into what's called the balance sheet. Now you notice that the heading for the equity statement says for a month ended, right? And so did the income statement for a month ended. The balance sheet, if you put that on, if you use that term, you're wrong. Notice it says January, or I'm sorry, June 30th, 20 whatever. The balance sheet represents a specific point in time. You cannot say for the month of, because these are not numbers that are going up like revenues and expenses do each month, and then they total them up, and that's the month. This is what you have at this point in time. So you have 470, 3,100. Where did we get those numbers? Where did we get the 470? Where did we get the 3,100? It came right from here. 470, 3,100, 8,700. So your total assets are 9,150. The accounts payable is 1,900. So let's go back. There's the 9,150. The accounts payable. We no longer have equity of 5,000. It grew to 7,250 after we added the income and subtracted the withdrawals. So those are the three financial statements. And you'll start getting them familiar now with your Cengage online activity. The balance sheet reports a firm's assets, liabilities, and owner's equity on a specific date. It also confirms that the accounting equation is in balance. If you're ever working with a computer system and you print the balance sheet and total assets don't equal the total liabilities and equity, there's something terribly wrong, okay? And they also call this a statement of financial position, statement of financial condition, balance sheet. Our three statements are an income statement, equity statement, balance sheet, okay? Let's see what this is. 3 phases of the accounting process. What could these be? I'm not so sure we want to go over this too much. The accounting process, input, you get some paperwork, you get an electric bill or something, and then you process it, you recognize the effect, and the output is the financial statements. I'd like to kick that slide out probably. Hey, I know you're disappointed, but we're kind of done here. Does anybody want to comment? Any questions? Anybody? No questions from anybody? Okay. I hope that means it went okay. Leanna, do you mind speaking to me?
Sure.
You have any questions?
No, I don't. I haven't read chapter 2 yet, so
Okay.
yeah. So once I get there.
Yeah. And you understand, Leanna, that this video will be on Canvas tonight.
Yeah.
It's also in my goofy Bob Smagula YouTube channel, where you can, look up anything you want for any of the courses. Okay.
Okay.
All right. One more, Rodrigo. You there? Maybe not at the moment. I'm just going to talk to one other person. I'm going to pick somebody at random here. One eeny, meeny, miny, moo. Hey, how's Anthony doing?
I'm doing well, sir. You?
Good. Any questions?
Actually, I do.
Well, come on, speak up, pal.
All right. The book that was recommended. So it's obviously supposed to be Cengage, apparently according to what we've been studying. But then in the course, it was recommended that the Wiley loose leaf college accounting was.
No. Yeah, where did you see that in the syllabus or something?
Actually, no. When you register for the class, it gives you the option to buy the book at the same time.
Yeah.
And so I did, because I wanted to be ahead, not behind.
You should be, well, you're gonna be able to exchange that book, obviously, and get your money back on that. Are you able to buy the correct one now, the Cengage? Get your
Well,
hands on
actually,
it?
I found out just last night when the gentleman from Cengage.
Yeah,
who-
Mahendra. Yeah, I saw, he copied me on the emails. Go ahead.
Okay, so I paid for the access code, which obviously isn't applicable to Cengage. So I
Yeah.
contacted the director of the bookstore, and I'm waiting for his phone call.
Oh, they'll certainly refund that to you. No problem there. And if you do run into any problems with that, let me know.
Okay, will do.
All right. All right. I guess we'll call it quits then. Okay, class?
Hello?
Glad we had a goodly number of people here. Let's hang in there and we'll see you all on Tuesday at 10. Okay.
All right.
Sounds good.
Bye-bye all.
Sounds good.